strategy for inflated stock bond market. I will explain this in much more detail in a little bit. So number one is rebalancing. When you go to rebalance your portfolio, I would, the reason it's important is because of this chart. I love this chart. This is a Callan chart. It's one of the things that you see when you're like 17 years old and it really sinks in and I go, oh, this makes so much sense. We don't need to all be experts on the Callan chart by the end of this webinar, but I will explain it very briefly. This year is 2001. Each one of these colors represents a different piece of the investment marketplace. So like this is just fixed income, the most conservative. In 2001, you had September 11th. The thing that performed the best was fixed income, right? The most conservative stuff. High yield is kind of junk bonds, small cap, emerging markets, so on and so forth. And we'll talk about large cap a little bit as well. So I think the point is you don't know. No one knew September 11th was going to happen, right? Or at least very few people in the entire world. No one in the US. So you wouldn't have known to pick fixed income investments, which is why it's important that you have some in your portfolio all the time. I don't think after having 2 years of having been middle of the road to bad, that most people thought the next 5 years was going to be amazing for real estate and emerging markets. And as a result of that, they really overweighted to those areas in their portfolio. Probably very few people knew that that was going to be the case, which is why it's important to always have some of that in your portfolio. And you could kind of do that with almost any color, right? You thought real estate was going to be great here. Well, it was pretty good, but it was terrible this year, right? And terrible a couple of years before that. And you could do the same thing with everything, right? Did you know emerging markets were going to be down 15%, this year, or 55% this year? And you just completely avoided them? No, you did not. So rebalancing, there's actually a big study done by Vanguard that talked about the value of a financial planner and like where does a financial advisor add value? And one of the big areas was in rebalancing, because people, their natural predilection is to not rebalance, right? They want to keep buying the things that are doing well, and they don't want the things that are doing poorly in their portfolio. But that's the wrong way to look at it. You want to have a well-diversified portfolio that you rebalance into the areas. So in this year, had you rebalanced into emerging markets that had lost half of their value, you would have been richly rewarded by then having them go up 79% the next year, right? So by having a little bit of at least everything and then slightly trimming them, over time, which we do quarterly for our clients. If you have an LPL account, chances are we are rebalancing it for you. So we're rebalancing it for you. And then we're changing inside of that also the size of the pie. So you might not want as much emerging markets as you had last year, but you always want to at least have some allocation to them. And I'll give you an example of what that looks like. So I think people, I'm surprised how often they don't really understand rebalancing. So let's say this is your desired allocation, right? And we want 15% international. And international goes down. So by the end of the year or by the end of the quarter, you're down to 9% international. But small cap did okay. And it went from 15% to 22. What you want to do at that point is not buy more small cap, right? Small cap did well. That's great. We're going to take some of those profits and we're going to go buy some of the international that is now at a discount. People think that this is crazy because they view it as one security. Like, why would I keep dumping money into something that may be out of business or gone in a year? It's important to remember the category of international is never going to be gone. Every single international company is not going to go out of business, right? So the category of international will always be there. The category of big US companies will always be there. There will always be some companies based in the US that are big. Those names change, but you keep bringing people out and putting new ones in. Like I said, LPL, where we clear through, just got into the S&P 500. Tesla got into the S&P 500 either earlier this year or late last year. So as new companies get a larger importance in the overall economy, those companies will be added and other ones that are shrinking will all fall out. In 1900, the whole S&P 500 is basically railroads, right? I don't think there's any railroads in the S&P 500 today. So the category is still here. The S&P 500, as you saw in that chart earlier, is still there and doing great. Just the names inside of it change. So as a result of that, the risk of buying something while it's down, it's not like buying GM when it was down before it went bankrupt, right? Where then you just lost everything. This is buying a category that will be there, So I think rebalancing is really important, and that's how it works. And that's a strategy, for our clients. Some of you on here might be not working with us yet, but for our clients that we're rebalancing, the bottom of the COVID recession was March 23rd of last year. We rebalance our clients' accounts quarterly. So within a week, within less than 5 trading days, we had taken a ton of bonds that we had built up in 2019. So in 2019, Trump tax cuts, markets up 25%. Every 3 months, we sold stocks because this was happening, right? Small cap would go from 15 to 22, large cap would go from 35 to 47. And every 3 months, we said we have to pull that back and get back to an allocation that, number one, fit the client's risk tolerance and that we thought was efficient. By doing that for that year where the market was up, then when COVID happened and the market was down 40% in 40 days, what did we do? We took, in some cases, up to almost half of clients' bonds and dumped them into the stock market while it was down 40%. Well, it's up 70% since then, or something ludicrous. So that's good, right? So that rebalancing works. And if you do it consistently, it works relatively well. So I think in a time of people being scared of the market being high, I think that rebalancing is a way to not drift more aggressive as the market's going up, because you constantly pare back your equity to a level of risk that you're comfortable with.